TSX soundly beating the S&P 500 this year. Is that likely to continue? We are joined by Sadiq Adatia, Chief Investment Officer at BMO Asset Management. Sadiq, thanks very much indeed. Really incredible, isn't it? Despite the big run for the US tech stocks, Toronto has held up so well.
Yeah, absolutely. And thanks for having me. Yeah, it's been an interesting year for sure. We've seen so much going on around the world, geopolitical risks, inflation concerns, changes on interest rates. But the truth is that we're still seeing a pretty healthy economy around the world. In Canada, international, emerging markets, all have played a little catch up to the United States. And so it's been a really well-diversified kind of rally across the world. And I think that's good for investors because it's not solely relied on the U.S., though I think the U.S. still remains a very strong economy and strong part of what you need to have in your portfolio. But it's good to see that we're seeing, a diversified mix of outperformers as well, too.
Are you concerned that cracks are emerging in the AI story? Maybe we can put up a 5-year chart for Oracle. It may be a special case, but there are concerns over a massive debt load of that company as it invests frantically in AI equipment.
Yeah, it's a great question. I mean, there's a lot of talk about it, whether there's an AI bubble going on. Have they spent way too much money and not getting enough payback? Our belief is that we're still in the early innings of AI still. And, what you're seeing coming out of China and other parts of the world are highlighting that this is going to be a big story, not just for 2025 or 2026, but for the next decade. And so, companies do need to spend to invest in that. You're seeing all the hyperscalers continue to do that. You just mentioned Oracle as one of the next hyperscalers in the space. And yes, you are seeing a bit of more use of debt versus actually cash to fund that, which is a little bit more concerning than previous. But I do think that as you look through, the strong players in this space are going to continue to dominate and continue to add good value through that AI spend. It's the other ones that are probably kind of just hovering around the edges that may not be able to get the bang for their buck. So to us, this is still an important theme that you want to continue to play out. Even saw the NVIDIA earnings to be exceptionally strong. So it just tells you still that the money's still being spent. There's still strong belief in what's going on. And we're still bullish on the theme. You're
still neutral on Canada, though. You're not tempted to overload or overweight this country in your portfolios?
Yeah, I mean, we obviously have a diversified portfolio, but where we think on the Canadian perspective is we're still seeing a kind of a weaker economy, employment not necessarily that strong, or GDP in that same level. We do still have some uncertainty on the tariff side, though there is some positivity that we might see the sectoral tariffs come down by about half. And we're heading into next year where we're going to have a rework of the USMCA deal. And though I think that should still be okay, it probably won't be the same terms that we're seeing so far this year. And so therefore, I do think we'll give up a little bit of that competitive advantage, not fully. And so I'd rather wait and see how things play out before we get overly optimistic about Canada. As you've seen over the last 6 months, the relationship between Canada and the US has gone back and forth numerous times. So I think I'd rather just wait out a little bit longer before we get overly optimistic about Canada turning the corner at some point next year.
Yeah, what would be your biggest concern about the Canadian economy?
Well, I think right now we're still struggling over a lot of debt. Though interest rates have come down, people have that big debt to deal with. The housing market hasn't really been exceptionally strong. And so consumer appetite is starting to wane, and that is an impact on, obviously, companies in GDP growth. So when we look through into next year, there isn't a catalyst right now that makes us believe that we're going to see consumers start spending excessively all of a sudden. Companies are still, holding back on, what they're going to spend on and look for growth on because they're waiting for the clarity on the USMCA deal and on the tariff side. So that just holds back that growth ambition that you want to see companies have. And that probably puts a little bit of a cloud over the Canadian economy. And that keeps us, again, a bit more reserved on Canada than otherwise.
What about this? How are you playing Japan right now? Because there are fears, of course, that this notorious or famous carry trade whereby people would borrow cheap in Japan and invest for higher returns elsewhere, that might be eroding as Japanese rates come up.
Yeah, that's an excellent point. Japan has had a good, a year, but as you have just mentioned, we are seeing some of the things change around, rates going up, inflation changing as well. So it's not the same Japan that you may have known over the last few years. On the positive side, there are things that are getting better within the corporation side. You're seeing more policies that are tied to investor-friendly investing, and that is good because that means it's tied to shareholder value. And that is a positive sign, from a longer term perspective. But I think in the short term, when you look at Japan, I think it's a bit overvalued at the moment. However, relative to maybe other European countries and broader international markets, I do think it's still, a relevant story to have. But again, I wouldn't be as overly excessive about it, given the run-up we've seen so far.
And just finally, bonds. Maybe we could put up the Canadian 10-year bond yield. Are you attracted by it, Sadiq, these days?
So we are neutral on Canadian bonds and U.S. bonds. I think when we're looking at things, I think we'll be more optimistic about U.S. bonds versus Canada, just because I think there's probably more room for the U.S. to cut rates than Canada at this stage. However, we still think we prefer, if we're going to take on any risk in the markets, we prefer equities over bonds. So again, if we're going to have bonds, we're going to have it more as a protection, which means more of a conservative nature versus credit, high yield, or emerging market debt. I think if we want to take on that credit risk, we'd rather take it into the equity market. So overall, we're kind of neutral on the bond market. Probably get a 5-6% return next year, but I wouldn't look for anything excessive past that unless we have a really strong, rate cutting cycle.
Sadiq, thank you very much indeed. Sadiq Adatia,
thanks for having me.
Chief Investment Officer at BMO Asset Management.